If you acquired silver this morning based on prominent headlines, I bring you unwelcome news. You likely served as liquidity for those exiting their positions. Yesterday, the financial sphere was abuzz with what was arguably one of the most optimistic reports to date. Bank of America, a titan of global finance, released a research assessment projecting a potential surge in silver prices to $39 per ounce. This news permeated every channel, from social media platforms like Twitter to financial news outlets and personal inboxes. Retail investors, fixated on the $39 figure, reacted with urgency, convinced they needed to invest immediately before the price soared. Consequently, this morning, Wednesday, January 7th, they flooded the market with buy orders, propelling the price of silver as high as $82.75. It appeared to be a significant breakout, the dawn of a dramatic price appreciation. However, the opportunity vanished precisely at the zenith of this widespread excitement. A substantial wave of selling pressure overwhelmed the market. The price didn't merely stall, it plummeted. We are now trading at $78.54, a decline of $2.62 on the day, representing a drop exceeding 3%. If you purchased at the peak of $82, you've already experienced a 5% loss within a single afternoon. This maneuver is a classic financial stratagem known as selling the news. Informed investors capitalized on the positive report to divest their holdings to less experienced market participants who were drawn in by the hype. In this urgent market analysis, we will meticulously examine the day's events. We will elucidate why major financial institutions disseminate optimistic forecasts at the apex of trading ranges. We will scrutinize the formation of a double top on the price chart, a concerning technical indicator suggesting further downward movement is possible. Furthermore, we will provide guidance on navigating this volatility without jeopardizing your investments. The headlines proclaimed $300, while the chart indicates $78. It is imperative to discern which narrative to trust. This is the chronicle of the Wednesday sell-off. To comprehend today's market correction, one must grasp the mechanics of a large player exiting a substantial position. Envision yourself as a hedge fund manager who acquired millions of ounces of silver at $60. The price now stands at $80, yielding a significant profit. You wish to liquidate, but a major obstacle arises. Executing such a large sell order would destabilize the market before you could complete your exit. You require buyers, millions of them, to absorb your holdings. How does one find such a vast number of buyers? A compelling headline is essential, a narrative so captivating that it compels retail investors to act impulsively. This is where the Bank of America report enters the picture. Silver to $39. Whether by chance or strategic planning, this report facilitated the ideal liquidity event. Upon encountering this headline, the collective retail investor base inundated the market with buy orders, creating a substantial cushion of liquidity at $82. The hedge funds responded by selling into this strength, profiting from the prevailing greed. They utilized the retail buying frenzy to offload their positions. This explains the abrupt price decline the moment the news gained widespread traction. The sophisticated players distribute their assets to the less informed participants, a timeless market dynamic. Buy the rumor, sell the news. The rumor was the impending breakout, the news was the price target, and the outcome was the price collapse. Now let us address the technical damage. Market charts possess a form of memory, with traders recalling past losses. Observe the chart from last week. On December 29th, during the quiet holiday trading period, silver experienced a surge to $83.71 before declining. This marked the initial rejection. Today, January 7th, we rallied to $82.75, only to face another rejection. We were unable to surpass the previous high. In technical analysis, this configuration is termed a double top, resembling the letter M, and it is a bearish reversal pattern. It signals aggressive selling pressure at the $83 level. Each attempt to approach this price point results in a forceful price reduction. This establishes a resistance ceiling until a decisive breach of $83.71 occurs. The breakout is currently on hold, and we are confined within a trading range. The upper boundary of this range is $83, while the lower boundary remains to be determined. We must also consider gold, the market leader. Gold is currently trading at $4,453, down $32 today, while silver has fallen by 3%. Gold's decline is nearly 1%, indicating a broader trend of selling across precious metals. The likely driver for gold's decline is the bond market. Yields have seen a slight increase today. Rising yields typically lead to selling pressure on paper gold. When gold experiences selling pressure, silver is impacted disproportionately, often 3 times as severely. This is the characteristic of high beta assets. Silver amplifies gains on the way up, but magnifies losses on the way down. However, a crucial observation is that gold is still holding the $4,400 level and has not experienced a collapse, merely consolidation. This suggests that silver's reaction today was an overstatement. It overreacted to the downside, much like it overreacted to the upside this morning, behaving like an emotionally volatile teenager in contrast to the more composed adult represented by gold. The adult is stable. The teenager is experiencing a mood swing. We must address the psychology behind a $300 price target. When an institution like Bank of America issues such a projection, they are referring to a long-term outlook, typically spanning several years, such as 2026 or 2027. However, the retail investor interprets the headline as an immediate prospect, expecting the price to reach $300 by the end of the week. This disparity in time horizons is a primary cause of investor losses. The bank analyst is assessing a supply deficit that will unfold over an extended period, while the day trader is focused on a 1-minute chart. The day trader invests short-term capital based on a long-term forecast. When the price drops by $2, their position is liquidated. It is essential to align your investment timeline with the underlying thesis. If you believe silver will reach $300 due to a structural shortage, a $2 fluctuation on a Wednesday becomes insignificant. It is mere noise. However, for someone trading with 20 times leverage to capture a breakout, such a drop can be devastating. Today served as a lesson in time frame management. The ultimate destination may be $300, but the journey is fraught with challenges. Nevertheless, we should not disregard the Bank of America report entirely. The fact that this institution, historically associated with short positions in precious metals, is now publishing optimistic targets is a significant development. It signifies a shift in institutional sentiment. In the subsequent section, we will delve into the Bank of America report. We will explore the reasons behind their revised target, analyze their commentary on solar demand and mining supply, and investigate whether Bank of America is attempting to mislead investors or signaling a reversal of their previous bearish stance. The perceived surge may be artificial, but the fundamental shift is genuine. We are examining the details. If you're just joining us, we have analyzed the market trap, observing the price surge to $83 driven by a headline, followed by a collapse to $78 based on market realities. We must now return to the source of the initial price acceleration, the headline itself. Silver to $39. This was not a projection from a social media influencer or a forum post. It originated from Bank of America Global Research. Within the precious metals community, Bank of America is often referred to as the Death Star due to its historical holding of one of the largest derivative short positions, acting as a force to suppress prices. They previously advised clients that silver was a speculative venture, merely an industrial byproduct. However, yesterday, the Death Star altered its trajectory, releasing a report that not only upgraded silver, but also reevaluated the entire asset class. In a bullish scenario, they suggested that silver could reach $39 per ounce by 2026. In the second part of this analysis, we will dissect that report, investigating why the most prominent bear on Wall Street has become the most enthusiastic bull. We will explain why this shift is more consequential than today's price drop and how this report provides a crucial authorization for the $50 trillion in pension capital awaiting deployment. While the price action was unfavorable, the fundamental signal was compelling. Let us examine the report. It was authored by Michael Whitmer, the commodity strategist at Bank of America, a respected analyst who engages with the world's largest money managers. In this document, he acknowledged three critical points that the broader financial establishment had long disputed. First, supply inelasticity. The report concedes that mining operations cannot simply increase output at will. It states that even with rising prices, mine supply is expected to remain stagnant or decline for years, undermining the bearish argument that higher prices will alleviate shortages. They acknowledge the structural nature of the shortage. Second, unstoppable solar demand. For years, financial institutions argued that solar panel manufacturing would diminish silver consumption and that engineers would substitute it with copper. Bank of America now admits this is inaccurate, projecting that the green energy transition will deplete silver at a faster rate than it can be extracted, validating the Samsung scenario that has been discussed extensively. Third, the monetary premium. The report links silver's price not only to industrial applications but also to gold. It suggests that as gold approaches $4,500, silver must follow to maintain their historical price relationship, acknowledging silver's role as a monetary asset. This represents a complete capitulation, akin to a military surrender. The institution that most vehemently opposed silver has now conceded that the underlying economic data is undeniable. Why is this report significant given today's price decline? Because institutional investors, such as pension funds, do not base their decisions on speculative commentary. They rely on research from major financial institutions. Imagine a conservative fund manager responsible for the retirement savings of public servants. They might wish to invest in silver, but hesitate due to fear of professional repercussions if the price falls. They require validation from a reputable bank to justify such an investment. Bank of America has now provided that validation. This report acts as a green light for the institutional world, confirming the safety of the investment and the validity of the fundamental case, removing the reputational risk associated with commodity ownership. Thus, while day traders were engaged in selling the news today, institutional investors were studying the report, forwarding it to their committees, and preparing to execute buy orders in the coming week. The report is laying the groundwork for the next influx of capital. A large financial institution requires time to pivot, but Bank of America has now initiated that turn. We must pose a critical question. Why would Bank of America release this report now? If they were still short silver, would they not prefer to suppress its price? This would only be the case if they are no longer short. The sole logical reason for a bank to project a $300 price target is if they are net long. We believe that over the past month, during the volatility of the holiday period, Bank of America likely covered its substantial short position, using the market's liquidity to exit their trade. Now that they have closed their shorts, they desire for the price to rise. They have switched allegiances, transitioning from price suppressor to price promoter. They aim to cultivate investor enthusiasm because they are now positioned to profit from it. This explains the aggressive price surge in early January, which was not solely driven by retail investors, but also by institutions front-running their own research. This is how Wall Street operates. First, they orchestrate a price decline to acquire assets at a low cost. Then they promote a narrative of significant price appreciation to sell those assets to the public later. We are currently in the telling you it's going to the moon phase, which, while cynical, is profoundly bullish for the price. Having major banks on your side is advantageous. When a prominent institution like Bank of America introduces a figure like $39 into public discourse, it expands the realm of accepted possibilities. Previously, advocating for $300 silver would have been met with skepticism. Now it is plausible given Bank of America's projection. This normalizes hyper-bullish price expectations and shifts the perceived value of the asset. Suddenly, $80 appears inexpensive in comparison to a $300 target. This psychological shift is crucial for sustaining market enthusiasm. Investors need to believe in limitless upside potential. This report fosters a self-fulfilling prophecy. Traders buy in anticipation of further buying, refiners stockpile anticipating higher future prices, and miners delay sales to align with Bank of America's projections. The target price influences behavior, which in turn helps achieve that target. Therefore, the impact of this headline should not be underestimated. Today's price decline was driven by market mechanics, but the narrative's value has increased tenfold. The concept of $300 silver has been firmly implanted in the market's consciousness, and ideas are resilient. Consequently, the narrative is positive, the major banks have shifted their stance, and institutional capital is entering the market. However, we must still contend with the stark red candle on the price chart and the current trading level of $78. Technical analysis operates independently of Bank of America's reports. It focuses on price action. In the third part of this analysis, we will examine the technical ramifications, specifically the double top formation at $83, identify support levels that must hold tomorrow to avert a deeper correction, and determine whether the overall trend has been broken. We need to ascertain if this represents a bear trap or a genuine trend reversal. The charts will provide the answer. Stay tuned for part 3. We are now drawing the lines. We have analyzed the psychology of the sell the news event and exposed Bank of America's pivot from a bearish to a bullish stance. Now we must confront the unvarnished reality presented by the price chart. For technical traders, the silver chart today is undoubtedly distressing, showcasing a significant bearish candle. We failed to maintain the $80 level and have formed a pattern that strongly resembles a double top. In this emergency breakdown, we will set aside speculative theories and focus solely on price action. I will explain why the rejection at $83 serves as a serious technical warning sign, map out the critical support zone between $75 and $78, where bullish forces must intervene to preserve the trend, and illustrate how, despite the unfavorable daily candle, the weekly structure suggests a bear trap designed to shake out investors before the genuine ascent towards $100 commences. The short-term chart appears damaged, but the long-term structure is robust. Let us examine the key levels. To be frank, here is what the bears are observing. On December 29th, we reached $83.71 before declining. Today, January 7th, we hit $82.75 and subsequently retreated. This has created two distinct peaks, forming what is known in technical analysis as an M-top or double top pattern. This indicates buyer exhaustion and a substantial volume of silver available for sale above $82, which the market is currently unable to absorb. If this pattern unfolds as textbooks suggest, the price should regress to the neckline, which is around $70. This represents a significant decline from current levels, hence the widespread panic on social media. Technical analysts are issuing sell signals because the pattern indicates further downside. However, there is a crucial caveat. In an inflationary supercycle characterized by shortages, technical patterns can frequently fail. A double top may evolve into a flag pattern with a handle. Instead of a sharp decline to $70, the price may consolidate sideways, digesting the available supply. Once sellers deplete their resources, the price can then surge through the double top resistance as if it were never there. I believe we are forming a handle, not a top, due to the trading volume. While the volume on today's sell-off was elevated, it did not indicate panic. Rather, it reflected profit-taking, matching the volume observed during the price ascent. Now observe the support bids. Every time the price approached $78.40, it rebounded. We are currently trading at $78.54, not crashing through the floor, but resting upon it. This indicates the presence of passive buyers at the $78 level. These are the institutional investors we previously discussed, the pension funds. They did not chase the price at $82. Instead, they waited for traders to drive the price down to them. Now they are discreetly accumulating millions of ounces at a discount. When high volume is accompanied by price resilience, meaning the price refuses to decline further, it signifies accumulation. The asset is changing hands, with weaker holders transferring ownership to stronger hands. Strong hands, by definition, do not sell. They hold for the next upward move. So, where is the critical support level? Where does the trend officially break? The defensive zone is established between $75 and $78. $78 represents immediate support, having served as the breakout level earlier in the week. Holding this level would indicate exceptional strength in the bull market, suggesting a retest of lower levels was unnecessary. $75 is major support, having acted as resistance throughout December. Recall the principle that old resistance often becomes new support. A decline to $75 should elicit a strong bounce. The entire market, including banks, algorithms, and individual investors, has buy orders positioned around $75. A breach below $75 would indeed signal a problem and invalidate the breakout, indicating a failed advance. However, at present, we are more than $3 above this danger zone, providing a substantial buffer. Therefore, a 3% decline should not deter you when you possess a 20% cushion. Let us examine the Relative Strength Index, RSI. Yesterday, the daily chart's RSI was approaching 80, indicating an overbought condition, meaning the market's momentum was overheated and required cooling. Today's price correction achieved this objective. The RSI has retreated to the 60s. This is a healthy development. One cannot sustain a marathon pace in a sprint. One must moderate speed, hydrate, and recover. The market is now recovering by resetting the RSI without derailing the price trend. The market has recharged its energy reserves, enabling it to attempt another push towards $83 next week. Had the price continued its upward trajectory today, a more severe decline would likely have occurred tomorrow. In a peculiar sense, today's drop has preserved the rally, averting a blow-off top and facilitating a consolidation phase. Consolidations can be perceived as uneventful, but they are essential for sustainable uptrends. We need to reassess gold's performance. Gold is down $32 to $4,453, a drop of 0.7%, a minor setback. Gold remains near its all-time highs and is in a powerful uptrend. Silver's 3% decline is attributable to its inherent volatility, but a bear market in silver is unlikely if gold remains in a bull market. Physics dictates this relationship. The gold-to-silver ratio has widened slightly today, moving from 56 back to 57, making silver relatively cheaper compared to gold than it was yesterday. This attracts value-oriented buyers. Algorithms that trade this ratio will likely step in to purchase silver and sell gold to narrow the spread. Gold is thus acting as an anchor, preventing silver from drifting aimlessly. I caution you about the headlines you will encounter tomorrow. Silver crashes, bubble bursts, investors flee commodities. The media thrives on sensationalism for increased readership. They will likely overlook silver's substantial gains for the month, focusing instead on the single day of decline. Do not allow media narratives to dictate your emotional response. The media is not privy to arbitrage mechanics or the specifics of market liquidity events like the G-SIP flush. They report price movements, not the underlying drivers. You, however, understand the mechanics and recognize today's event as a sell the news occurrence, triggered by the Bank of America report, a tactical correction, not a fundamental failure. Therefore, while the chart appears unfavorable, the underlying structure remains sound, support levels are holding, and indicators are recalibrating. What should be your next course of action? Should you buy the dip, sell the rally, or endure the current downturn? In Part 4, the concluding segment of this market update, I will outline a recovery strategy. I will provide precise guidance for navigating the next 48 hours. We will analyze Friday's closing price and the significance of the weekly candle in determining the market's trajectory for the upcoming month. Finally, I will offer a definitive verdict on the Bank of America target. Is $39 still a realistic projection, or was it merely an illusion? The trap has been set, and the less committed investors have been removed. Now, we will observe who remains in the market. Stay tuned for Part 4 as the final plan is revealed. We've arrived at the concluding segment of this urgent transmission. We've thoroughly examined the sell the news scenario that precipitated the market downturn. We've uncovered the conspicuous reversal in strategy from Bank of America. We've meticulously analyzed the technical repercussions of the double top formations and the shooting star candlestick pattern. Now you find yourself with an investment portfolio showing significant losses. You're observing the price hovering around $78.54, and you're pondering the very question that preoccupies every investor during a market correction. Is this the end? In this final in-depth analysis, Part 4, I will furnish you with a strategy for recovery. I will meticulously detail precisely what indicators to monitor over the forthcoming 48 hours to ascertain if the upward trend remains intact. I will elucidate why the weekly closing price this Friday is the sole figure that truly holds significance. And I will address the $75 target. Is it an unachievable dream or a viable plan? The mechanism of deception has been activated. However, if you've maintained your holdings, you haven't been ensnared. Let's bring this to a resolution. Within the realm of professional speculation, novices initiate market activity while seasoned traders conclude it. The everyday fluctuations, the surge to $83, the decline to $78, are merely skirmishes within the trading day. The prevailing direction is determined by the weekly settlement. We have 2 trading days remaining in the week, Thursday and Friday. The objective is straightforward. The proponents of an upward trend must secure a weekly close above $75. If we conclude the week above $75, the weekly candlestick will exhibit a lengthy lower wick but a positive body. This will serve as confirmation that we are defending the level of the prior breakout. It will signal to the automated trading systems that the trend is upward, albeit with notable volatility. This outcome is acceptable. However, if the opponents of an upward trend succeed in driving the price below $75 by Friday afternoon, it will signify a failed breakout on the weekly chart, indicating a more substantial downturn. Consequently, your complete attention should be fixed on that $75 threshold. It represents the critical distinction between a minor pullback and a fundamental shift in the prevailing trend. Considering the tangible scarcity of the commodity and the robust performance of gold, the probabilities favor the bulls successfully defending this level. Now, let's reconsider the Bank of America price objective of $39. Observing the current price of $78, that figure appears preposterous. It seems unattainable. However, it is imperative to distinguish between the timing of an event and its ultimate outcome. Bank of America did not suggest that silver would reach $300 on a specific Wednesday. They posited that the underlying economic factors support a $300 valuation within the current economic cycle. Have the fundamental drivers changed today? Have solar panels ceased to require silver? No. Has the national debt ceased its upward trajectory? No. Have new discoveries of silver deposits been made? No. The economic calculations that lead to a $300 price remain valid. The confluence of inflation, limited supply, and a recalibration of monetary policy logically points to a triple-digit valuation. Today's price decline was an event driven by market sentiment, by emotional reactions, not by fundamental economics. The underlying economic reality will ultimately prevail, but it requires time. If your decision to acquire silver was predicated on the belief in the $300 projection, a $2 decline should not cause you to waver. This represents a mere 0.6% correction on the trajectory toward a 400% appreciation. Maintain your focus on the distant horizon, not the immediate obstacle. I wish to impart the most challenging counsel in the financial world. Occasionally, the most astute investment decision is to abstain from any trading activity. When the market is exhibiting such erratic swings, when it is trapping optimistic traders and punishing pessimistic ones, the most prudent course of action is to disengage. Attempting to profit from this volatility by selling at $78 with the hope of repurchasing at $76 will most likely result in losses. The market will reverse its direction the instant you execute a sell order. Its design is to maximize your feelings of regret. Therefore, the recommended approach for the remainder of this week is passive observation. Allow the major financial institutions to contend with each other. Let the automated trading systems generate trading volume. You are in possession of the physical commodity. You are an observer of the speculative arena, not a participant in every speculative gamble. You already own the arena itself. Simply await the conclusion of their games. However, if you currently possess available capital and missed the initial upward surge around $70, this market dip presents a second opportunity. It is the market granting you a reprieve. We have re-entered a favorable buying range. Any price point between $75 and $78 is an advantageous acquisition. You are acquiring an asset that experienced a breakout and is now retesting its support level. This represents the entry point with the lowest degree of risk available. Cease anticipating a return to $60. $60 is no longer a relevant price level. The new baseline is higher. Recognize the potential benefit inherent in this challenging situation. While others are succumbing to panic and selling, you should be making decisive purchases at a discounted price. Consequently, here is the definitive assessment of the deception. Bank of America published a report to facilitate market liquidity. They leveraged retail enthusiasm to divest a portion of their holdings or to rebalance their financial instruments. It was a calculated and unsparing maneuver, but it does not alter the fundamental truth. The truth is that silver is the most undervalued asset in recorded human history. The truth is that wealth is migrating from the west to the east. The truth is that the price is destined to rise. Irrespective of what transpires on any given Wednesday in January, you have successfully navigated this period of market instability. You remain steadfast. Do not permit them to undermine your conviction. Do not allow them to confiscate your silver. The journey toward $300 is not a direct path. It is a conflict. And today, we incurred some casualties, but we continue to advance. Maintain your resolve. Monitor the $75 level diligently and recall the fundamental reason that initially prompted you to accumulate this asset. Subscribe.